Well, thanks for tuning into Alpha Moguls, a show where we speak to some of the finest investing minds about how they are looking at portfolio construction in the current times to generate alpha in their portfolios. Our guest today is Kenneth Andrade of Old Bridge Capital. Needs no introduction. When we started Alpha Moguls, Kenneth was the first guest, and it's always a pleasure having him. Kenneth, so good having you. Thanks much for joining in. Um, can I start off with a bit of a here and now and then move on to the overall portfolio construction? Do falls like how they happened yesterday worry you? Because I was looking at a statistic which showed that this happened in June when the SPX dropped about 6%, and even post that we are up 15% for from that point of time. So do falls like yesterday worry you?
So I do expect the level of volatility to be significant. And now, when I say volatility, it extends both ways. Okay, and that's got a. There's a simple reason for that is that uh, globally, governments along with central bankers are holding up asset markets with all the liquidity. But on the real economy, the news is not very positive to justify whatever is happening. So, from an investor mindset, he's always on the defensive. And when you're on a defensive, and given the level of new participants in the marketplace, this volatility will extend itself for quite some period of time. So my sense is it will continue to be there, but I'm not too sure you need to be too worried about it. At least in the Indian context, may not be. There is some kind of a bubble that is there in US stocks or in some of the tech names that are there in US. India is still very much uh, an economy or a stock market which is driven by the very conventional businesses that we've seen in the past.
Interesting. So is that the reason why you say in the Indian context there might not be a bubble territory? Because everybody keeps on throwing data about how the GDP growth is and how the earnings growth is likely to lag, and therefore valuations are just too steep for comfort.
So the top earnings growth lagging has been around for some period of time. But just remember, Neeraj, it's just a period of 1 year. And if you have to value markets, don't look at 2021 to value the market. Look at year 2020 to value the market.
Okay. No, sorry. Did I miss you? Maybe the frame is got
No,
frozen. Sorry, Kenneth, I just lost that answer. Could you say you were saying that don't look at 2021 but look at 2022?
yes, to value the market. Okay, because if corporate India even returns back to 2020 numbers in year 2022, we are in a fairly fair priced economy, a fair priced market right now.
Okay. Just wondering, since would the other factor driving this is also that other asset classes are offering fairly meager return opportunities and therefore stay in equities? Otherwise, I mean, for 2 years, if the earnings growth is not necessarily going to come back, you could look at alternatives too. But that may not be an option currently.
So when you took a look at alternative asset classes, remember the alternative asset class is fixed income. Okay, it is the commodity markets. Okay, and to an extent it is gold, and gold is effectively counters the volatility that is there. But if you look at fixed income, and if you're seeing that there's going to be little or no return from the fixed income market or even from the commodity market, effectively they are deflationary in nature. I won't say they're deflationary in nature, but you're saying that there's deflation in that market, or even if they're constant. Now, those are the two biggest cost elements for corporate India: financial cost and commodity cost. And if they're going to be benign, um, and uh, and and the, and corporate volumes or industry volumes come back, I think there's fair amount of profitability that will come back to corporate balance sheets.
Okay. Is that your premise, Kenneth, of how you are going about portfolio construction, that some spaces will see a revert to mean of volumes and profitability, or is it different? What's your investing hypothesis currently?
2022, you will definitely see a reversal to mean of corporate profitability and volumes to a very large extent. But if you try and push it a little further, if you try and argue the rest of the decade out, what probably is the biggest trend that is shaping the next decade. Now, I'll just reduce this to through a quantitative look into corporate P&Ls over the next decade. And what we come across and what we're seeing actively on the ground is that the three large costs that exist in corporate profit and loss accounts or expense sheets. One is power cost, okay, or electricity or fuel cost. Second is wages, and third is interest cost, okay, or cost of capital. And all three are showing no signs of any inflation out there. Okay, if you just look at power trends that are happening in India and also globally, you're seeing a huge deflation in that one line item. Power costs account for close to about 8 to 10% of industry cost. Okay, I can say that this is not definitely not going to go up. If at all, it's coming down. Wages, given what has happened in the world over the last 2 or 3 years, I think you hit the peak of wage inflation for some period of time. If at all, it's only getting it will remain static, and in most cases, it will come down as automation continues to drive processes now or manufacturing now. And the third is interest cost. I think the biggest problem that India will face, I won't say India will face, or the banking system might face over the next decade is corporate India is deleveraging too fast. Okay, so you're in the final leg of it all, and corporate India is deleveraging at a pace that we probably haven't seen before. And that effectively means they don't need money to grow. So if you take these three large elements of cost of corporate balance sheet, of a corporate expense account, and that's almost 20% of your total expenses, and that, if that's moderating itself, I think that will dictate the trend of profitability or how we need to get profitability in the next decade.
Okay, interesting. So, Kenneth, I want to pick up the point number 2 that you mentioned first, and then we'll talk about the others as well. That the wage inflation point. Now, that could be happening due to 2 reasons, right? One, we could have a factor of automation taking in jobs, and maybe in wages not moving up as well. My question from an investing perspective is that would you look at companies which are the tried and tested but having lower wage inflation and therefore profitability moving up, or would you look at the newer sectors or newer themes that are cropping up which are substituting the way manpower used to work, and automation is substituting that? I'm just, if you can get my question, how are you approaching that portfolio construction?
So you can play it at either ends of the entire spectrum. You can play it because corporate India's costs are coming down, and that will contribute to profitability. Okay, but the more efficient way of doing it is effectively trying to pick businesses that are actually bringing wage costs down. Okay, so the businesses that dominate automation, companies that are contributing to incremental throughput of the manufacturing process without the need for labor, I think those guys will offer a reasonable amount of growth because it's a decadal play and more. And they should do very well. The other extreme, I think everyone will benefit. So I'm not too worried about that other extreme of the marketplace.
Okay. Okay. So let me try and I have a few follow-up questions to the peripheral side of the portfolio. But let me try and ask you, Kenneth, that you mentioned in the first few answers that you're looking at the next decade. So when you're looking at the next decade, and with an assumption that India Inc. at large is reducing manpower costs, power costs, etc., and interest costs, it would benefit everybody. So therefore, if that is a constant across, how are you then picking up the winners? Are you picking up themes which are likely to do better based on pure business fundamentals, or because some of these businesses were leveraged and they are coming back and not leveraged, and therefore the beta may be high? Can you give us a sense of how are you building a fresh portfolio if you were doing that?
Uh, so if you ask me on a poor portograph, companies will be much more, or companies in India or businesses in India will be much more competitive in the global context. And that's your biggest opportunity subset as you go forward. Second is the scale of opportunity that you're seeing. If you are just an India-centric business, you're targeting about 3% of the world GDP because India is 3% of the world GDP. But if you expand it to the rest of the world and you target 100% of the world GDP, then you open your horizons to it. Open a significantly large market out there. So if you know you got your costs under control, then you can take the risk of actually putting together a fairly scalable business model which starts the big global economy. And that's how I would like to believe that the portfolios will need to be built out. Hmm. So going to be globally competitive. There is an opportunity to go out and build a global franchise, and given the realignment of global India will play a fairly large part in, or Indian companies can play a fairly large part of, can fit into supply chains across the world in a number of new industries that are there than the conventional IT, pharma, chemicals businesses. So that's a small domain that we're probably looking at. And when we actually started this entire process, we just looked at it from a basis what gives us the competitive advantage. I think all of these little things that are falling in place are giving us the competitive
Interesting. When people look at global themes or export oriented themes, even now, like you said, Kenneth, I think, or like you alluded to, most people think of pharma, IT, chemicals, specialty chemicals, maybe to an extent textiles, though I think our neighbors are really taking away that or have taken away that advantage in the recent past. What else is there? Is it some bit of manufacturing that comes in? Because we're seeing back-end manufacturers in India for the Indian market doing well, but what what aside of the three themes that you spoke about you believe can succeed on a global scale?
No, you'd have to look at niche opportunities out there.
Okay.
Quite obviously, India hasn't done very well as a country. We haven't done well in mass market in mass market products. Okay, in the automotive chain, um, we've got good companies out here in the automotive supply chain. We've got really good, really large, scalable businesses with a global footprint in manufacturing, not just an India footprint in manufacturing, a global footprint in manufacturing. You're seeing a little bit come up in the ceramics business. Okay, and these are manufacturing businesses. Some of them are not really listed, but they are manufacturing businesses which are which 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 have established the first leg of dominating niches in that space. Okay, so the engineering business that is there, and you have a number of MNCs who also mm, put capacities in India, and a lot of them are addressing their international subsidiaries through the Indian through the Indian companies. So I think you necessarily have to look for niches and companies that have really established themselves. Some of them are category leaders also globally, but they are very small as industries by themselves. So I think you'll have to look at it on a case to case basis rather than making a general assumption that everything in India will do well.
Okay, so you are saying this is a lot more bottom up, unlike IT or pharma or chemicals. It is not an industry wide thing, it's a lot more bottom up. The opportunity, the major opportunity that you're seeing, is my assessment correct?
Um, Everything started bottoms up. You had one success in a company, and the peer group actually followed.
Sure.
Okay, so we need to go there and get one company out there which has gotten scale, established scale, and then the rest of the uh, rest of the peer group actually follows the business model. It started with IT in the same way. It started in pharmaceuticals in the same way. So you didn't have 10 IT companies going to the same client and asking them for business on day one. It started and then it incrementally and the opportunity. What we need to look for is, do we have the DNA and do we have the advantages that will drive this? I think that's all falling in place. And frankly, given the realignment of manufacturing or the requirements of, of another source of global supply, I mean, a lot of countries will fit in. India will also will put it. Some of the entrepreneurs from India will also put their best foot forward.
Okay. By the way, to those participants who are online right now, if you have a question for Kenneth Andrade, please do send in, and I'll try and take them if time permits, because I have a bunch of questions of my own. Kenneth, a small follow-up or a small clarity. Almost everybody seems to be betting on how, because of the Make in India push, that companies which are catering to import substitution are going to do well. You, as your major theme, and please correct me if I'm wrong, but your major theme seems to be quite the opposite of that, in that you are saying that companies which will bet, or you are looking to bet on companies which will actually cater to the global landscape. Where is the dichotomy here?
There's no dichotomy. I mean, I'm just saying that India is 3% of the world demand. And if you go out, you got 100% of the world demand. So you can't be profitable internationally without being profitable in India. So if you create the scale in India, you can take the capacity globally. I mean, look at India's largest four-wheeler manufacturer or two-wheeler manufacturers that are there. You are profitable in India and you generated your cash flows. Those cash flows have helped you get the dominant franchise and foothold in a different part of the world. And then you build the momentum of capturing higher global market share.
Sure.
The evolution of every industry which is globally competitive comes from a domestic cash flow.
Of course. But in which case, Kenneth, then the size of the pond that you're fishing in is essentially comprising of larger mid caps or large caps in that fashion, right? Because or am I wrong that a company which is too small in nature might anyways not be able to compete on the global landscape, right?
Not necessarily so. I mean, if you look at the tire manufacturing process, okay, and you look at all the intermediates that go into rubber. We've got very dominant companies out here, global companies out here. If you look at, I mean, chemicals, we keep talking so much about chemicals, but in a very specific segment of the market, which is agrochemicals, okay, we're fitting into the supply chains very effectively. And not all of these companies are extremely large out there. I mean, 3 years back, they were non-existent in terms of size. Today, they're mid-sized out there. But there are newer and newer companies coming through the cycle. So it's a wide canvas of all of them that is available.
Okay. Kenneth, the last few years that we've spoken about, you've always told me that one of the ways of investing, the 1,000 ways to skin a cat, but one of the ways to do it is to look at companies which were leaders in the previous cycle, have survived that cycle, and now try and identify when to bet on them when the cycle is turning around. Are you still doing that? And what are the factors that you use to identify the change of a cycle?
So there's no change in the way we work, and there's no change in trying to identify where the cycle is peaked and where the cycle is dropped. And if you look at it back, I've been in the system since 1990s, investing a little before that. And if you put 2 or 3 decades that you spent time in the market cycle, every decade it throws up a new characteristic of a new bubble economy that gets created. So it was technology, it was cap goods and materials, then it was consumers and financial and consumer finance franchises that recently happened. So if you don't participate with all of that, you're probably not making significant return. But the entire effort is to try and anticipate it. So how do you try and anticipate it? So maybe we're getting back to the 90s all over again. So India probably revisiting its 90s all over again. And that's not just a bad thing, because some of the And some of the most competitive businesses that got set up in India came from the 90s. And hopefully we'll create a number of new ones that come through there. So let's go back into capture large companies at the bottom end of the cycle. We are not doing anything new. I mean, if you are looking at a chemical business, you look at a chemical business that survived 20 years, established all the competencies that were there, and to an extent had scalability, which was built in, but didn't have the opportunity size. You just had to wait for the opportunity to come in. So when we look at all of this today, you have to just scale the size of the opportunity, and companies that were just waiting for this opportunity to materialize, they are all there already. So you're not looking at anything new. You're looking at the bottom end of the manufacturing cycle, probably. You're looking at the bottom end of the utility cycle. I mean, there's nothing happened in power and utilities for an extremely long period of time. Okay, and you participate with the most competitive or the largest in that entire segment.
Okay. Okay. So while you may say that there is nothing that has changed, I'm just wondering if the nature of the liquidity, the nature of the new businesses coming in, change this uh, or add some factors to um, identifying the cycle or picking up winners in the cycle in any fashion whatsoever.
Um, I mean, technology will come in, and there will be technology disruption in every business that is there. Uh, so, so, so when you look at my when I first highlighted those three costs, which are actually coming down for corporate India, those three costs are coming down because there are new companies out there that are driving those costs down. Okay, why are power tariffs dropping below their historical averages globally? Significantly below the historical averages, because there's new kind of there is new utilities that are driving costs that low. Okay, and if that's going to be the case in point, uh, then then obviously you have to adapt your investing style to pick up those opportunities that are there. So there are new age businesses that will also come in. But those new age businesses, but the older companies need to adapt to those new age businesses and make it a part of their uh, make it part of their business model as they build it forward.
Yeah, I just put myself on mute so that the voice
Yeah.
doesn't come in. Yeah. Okay. Thanks. So the next couple of questions, Kenneth. One, I'll stick to first the new age businesses, etc., and how do you kind of go about doing those? Some nuggets there, and then some of the established businesses and what happens to those teams. So first, new age businesses, right? So everybody believes that TMT is right, the discovery of the COVID-19 period, right? And telecom, for example, hypothetically, is looking very, very strong. It's a highly capex intensive business, even though it's a business which has in India at least only 3 players now. Maybe globally that thing may be different, but because it's highly capex intensive, the ROI may not be as strong as some of the other businesses. So there is promise here, but there are some issues about capex and ROI over the case or the lifetime of the business. How do you take a decision whether you want to be in telecom or whether you don't want to be in telecom?
So I mean, it's not a new industry. It's just the way that the industry is transitioned forward. So if
Yes.
you just have to align it to something that has been in the past, um, you had companies that built the roads, right? But the guys who put the cars on it, or the automotive manufacturers, made more money than if you're a shareholder in the automotive company over a period of time, you made much more money than the guy who actually built the road, right? So when you look at a network company, you effectively need to figure out that, I mean, a network company can only price its product at X, but everything that goes through the network is going to price it at X plus a significantly higher number. And that's what you're typically seeing. I mean, none of these large tech-enabled businesses globally own the networks. Okay, but their market capitalizations are gigantically higher than what the networks are.
Right.
So what extreme do you want to do? I mean, at the end of the day, uh, it is happening that the network is in place, but people will but content or the enablers of the network will create much more content out there for you and will be much more profitable.
Are there already existing plays like that, which are sizable in nature in India, which are taking advantage of the network?
There are
Okay. 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 The other thing is technology, Kenneth. And while the common refrain is that Silicon Valley is doing all the innovation and Indian IT service providers are kind of derided for being just that, service providers and not product companies, and therefore will always be the second rung players. Do you believe there is possibilities of scale, size, substance here in Indian IT?
service companies will remain service companies. I think that's what they are built to do. They have never claimed that they're going to be at the cutting edge of innovation, but they're going to help the process of innovation, and they'll get a fair value of whatever is there on the table to believe. So these are all largely commoditized businesses.
That's true.
Mm.
Okay.
Which is
Okay.
why they will not show you significant volatility in margins. Of course, there will be volumes which are switch on, switch off at periods of time, but they are fairly steady state businesses and will have their bouts of growth, and some of them will grow faster than the market, and some of them will lose market shares.
Okay. Because remember, it's not as simple as Kenneth makes it out to be. It is experience that speaks. But yeah, okay, we've got a couple of questions which are not necessarily sectoral, and I love that. So let me try and ask those. And if you have more, just please send in. But I think, KK, you asked about which particular parameters should one look to identify sectors, companies going through the bottom of a cycle. I think I asked Kenneth that, but in case, Kenneth, you want to just respond to that as well. Parameters that one should look at to identify the sectors and companies going through the bottom of a cycle.
So historically, the way I've seen it is, so the way we work or we try to work is low ROEs to high ROEs, low margins to high margins. Okay, when a business is struggling, when a number of businesses within that industry is struggling, you would effectively see big companies at extremely low operating margins, and that's one of the simplest way of identifying it. And when everyone does well, the whole industry is profitable. So when you get back to a commodity business, and a commodity business, it always happens. In India, it always happens. There are one or two companies make profits, and everyone else makes loss. And that's the time that it's time not to it's then it's time to actually start looking at all of these participants. And then there's the other extreme when everyone makes a profit, and most analysts extrapolate it on I mean not just analysts, investors, and to an extent even portfolio managers extrapolate the last 2 years of performance into perpetuity, and where we all make our mistakes, right? So it's as important to identify the top of the cycle as it is to identify the bottom of the cycle, and they are all there in financial numbers.
Got it. Okay. A follow-up question, Kenneth, is I mean, I would presume that being too early in the cycle could be as damaging as well, maybe. So, is there a way to identify of being too early in the cycle, how to make out the difference, whether, if it is even remotely possible?
No, you can't. You have to have the patience to go through the cycle with these companies. But when you use it as a portfolio approach, you probably have three or four industries that are all. Some of them are always doing something. I mean, you got to be extremely unlucky, but at times that also happens when you probably invested in four industries and all of them are not doing well. But like I said, you have to be extremely unlucky to do that because every industry has got its own life cycle. Okay, and if you diversify across three or four industries and not more than four industries, then you will be in very different life cycles of the business, and you will always get things right. It takes about 3 years for these kind of portfolios to stabilize.
Got it. Okay. Kenneth, the other bit would be what you spoke, of course, of the profitability metrics looking okay, but a lot of people speak about the near term being riddled with so many potholes on the GDP front that even if the markets and the GDP may have no correlation, but top line of companies and the GDP would have a correlation. simultaneously, there is a thought that a lot of Indian companies are now outward facing and don't necessarily depend only on the Indian GDP. How do you, what is your view here?
I mean, see, if I can answer that in two parts. India has always had its problems. Okay, yet we are close to an all-time high in the index. So it's just park that thing. Okay, we got to overcome those problems, and entrepreneurs in India have largely overcome some of those issues. Two, there is a correlation between sales growth and GDP. Yes, there is. And when you see a decline in GDP and you see a decline in top and turnover, remember the positive spin to all of this is you got a very low base to start from in the next year, and the next 2 years, if you can even come back to normal, you should be quite okay. So, 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 so look at the numbers, but just don't get over influenced by the near term. Because when you look at the numbers and anticipate a 20% drop in GDP, your market and market valuation might already be there. So many indices did decide to correct, and quite significantly at that, and some of the small cap and mid cap gave way completely. Remember, every single company has got an entrepreneur who wants to survive and wants to grow, and he will do everything for it to come back. Okay, and there is a value for the underlying business. So as long as the financial characteristics are right, you will find value in those. So, so you've got to be a little brave when the tide is against you, because everybody will come back, or a lot of us will come back.
A lot of us will come. Okay. Well, I love the first part, and I'll park that in my memory, Kenneth. Thanks for that. Okay, a couple of things, Kenneth. The last, I mean, I know you don't like being asked about why are you not in financials, so I won't get there. My question is a bit of a follow-up to what you mentioned in the earlier half of the interaction, that Indian banks will have this issue in the next decade because companies are a lot less leveraged, and therefore that's a bit of a thing that goes against business. Would you therefore reckon that this whole narrative of the big banks getting bigger and more shareholder return friendly might be a bit of a bogey, and there are better investment opportunities, even if they might grow and give returns, there might be better returns from a portfolio perspective in other spaces?
See, firstly, I like to clear the air that I don't invest in financials. What we like to do is that we try to like to see cash flows and identify with cash flows. And if you're someone who's following cash flows and like to identify with cash flows and see your business is solvent, okay, financials are usually a leveraged 10x. And unless they come at a significantly deep discounted value, while we know everything else is hygiene, we don't mind buying that. But I wouldn't want to say that I like cash flows and I like cash flows and I like deleveraged businesses, and then go and buy a financial services company which is leverage 5x or 10, or lending business, should I say, lending business which is 5x and 10x leverage. So I just like to clear the air on that. It's not that we don't like it. I mean, there are opportunities that will come out there. There are large customer franchises that are there, but we take our time to decide where and how we will like to build a portfolio out there. Okay, so that answers the financial question. The system will come back. It's going to take its time for it to come back, and there will obviously be a consolidation before there will be a fragmentation all over. Okay. And the big banks will become larger. So there's an opportunity in that space for the larger companies to grow larger. And there is enough of capital, like we see when every business actually is going out to leverage itself or to raise capital, they're getting capital, which is there. So that's the advantage that you have on in that part of the world, that companies are raising a lot of capital. They are strengthening their balance sheet, and when the opportunity comes, they will consolidate and grow larger. So I'd stick with the larger companies then, if I have an affinity for it. And once things settle, I'm sure these guys will also deliver reasonable amount of returns.
Okay. Kenneth, the other thing, from all the portfolio managers that I have spoken to in the last few years, you've looked at the agrarian space, maybe the closest compared to the rest, at least in my knowledge. Now, I was listening into a recent interview that I think Pranab Sen gave on one of the um, portals, wherein he likened the agrarian reforms in the last 3 months to 1991. Now, I'm not saying that that is the case or that is not the case. I'm not an expert out there. I'm wondering if you believe that the investment case in agrarian, rural, exposed or focused businesses has become stronger over the last 12 months, or no?
So what you're seeing is near-term data, okay? And while the reforms are genuine and they are large, the near-term data just suggests that the entire pump-priming of the economy that is taking place, or the limited amount of capital that the government had, they pushed it into the rural hinterland.
Hmm.
Okay, and what you're seeing out in rural India is a surplus of cash flows that have come to the farmer. It's just keeping that economy fairly buoyant. This also addresses that the reverse migration that has taken place, and just to keep everyone employed and people content, there is cash flow that is prevalent in the system. Agriculture by itself will never pull India out of its distress, but agriculture has to be profitable by itself, which it is not. Okay, and you have to get reforms down there. So those reforms are there. The implementation of the reforms we will see happen over the next 2 or 3 years. And hopefully some private sector participants will emerge which are fairly strong in that part of the world. There's too little uh, there's too little private sector participation in rural India at this point in time, except for probably the FMCGs. eh, I mean the consumer participants out there. But apart from that, there's not too much that is happening in that part of the world. So it is an opportunity that is there, but I wouldn't say that it's going to be a significantly large investment case. Agriculture is 15% of India's GDP. It will come down as a percentage to India's GDP, and the rest of the economy is going to grow.
Would the companies, though exposed to that space, be more profitable than what they've been in the past, and therefore attract attention? Just wondering.
Like, and the companies that are there are very profitable, and the profitability is only going to get larger. And it's also the last domain after the banking system, which is still dominated by the public sector.
Ah, okay. Okay.
Okay, so if that business gets profitable, which we have seen emerge, then private sector will lead to public sector inefficiency.
So, despite the sector's contribution to overall the GDP pie, you would presume that, or you would believe that the investability of select spaces in that pocket still exists, or
So of
is
course,
strong.
it is. Remember, that's a part of the world that has seen no reforms, no investment, and still depends significantly on labor
Labor.
and labor arbitrage between urban India and rural India to drive that economy.
Got it.
Okay, if you reduce the entire agricultural economy in terms of a profit and loss, or in terms of numbers, I mean the opportunity is staring in your face is almost 2x the size of what it is.
Okay.
Okay, so it's not that I don't think that is that. The number of participants in that part of the world are so few that you can actually count yourself as to who holds all the profitability matrix and out there.
Okay. Okay. And you reckon that the market would now probably reward them with better valuations as well? I mean, I hear that refrain for some of the sectors, not all, but you reckon that that could happen too?
I mean, there are 5 companies worth investing in that part.
Okay, fine. Let's okay, fine. Get the drift. Kenneth, one final. Okay, actually, maybe there's one more question, and then I'll have one final question for myself. Ah, I don't know, Abir, if Kenneth wants to answer this, but I'll ask nevertheless. Kenneth, can you comment on the PSU companies and the possibility of privatization-led benefits to the PSU companies, considering the cheap valuations?
If I go by history, I mean there are very few companies who have gone down that path and have and has generated significant amount of wealth for shareholders. Okay, but I'm just looking at history as an extrapolation for the future, and the probability of that happening is very low.
Yeah. Even for businesses with moats.
I don't think there's a business with a moat out there.
For lack of a better word or lack of a non-obtuse answer, a question: oil marketing companies.
I mean, look what's happening in the energy market, and you will know whether the oil marketing companies will be alive in the next 10 years.
Okay. Okay. Well, that's a fair point too. Kenneth, anything that kind of emerged and surprised you? Because I mean, for a few market participants, Tesla's move has been a bit of a surprise, and for a few it hasn't, because they see it as a pointer towards maybe, like what you said, an indication of what could happen to the energy market or something. But anything that has happened in the Indian or the global context that has surprised you in the last 6 odd months?
In the last 6 odd months, I mean, not really. I don't think so. I mean, what's happening in the US is those domination of those 5 or 6 businesses that are there, but that's been happening for a while right now. The scale and size of that opportunity, those companies are significantly large. But what I while those numbers and profitability of those companies are large, uh, I I I don't know. I don't know if it's a bubble or it's in something. It's in continuity. But I'd be a little wary of of uh, of extrapolating what's happened in the past to those companies into the future.
Of course, yeah. Okay. Okay. One final question, Kenneth. One very popular thing that wealth teams across the country are talking about is Indians can ideally take some exposure to global equities as well, and not just remain in the Indian pond. Are you a proponent of that in any fashion whatsoever?
Yes, if you know your markets abroad, you can very well invest in that part of the world for sure. As an equity investor, if you know your markets out there, you can very well invest in that part of the world.
I'm presuming you do know most markets very well that you would invest in. Are you taking that choice of investing in the global stocks as well in a
Yeah, there's a
larger
little
fashion?
bit of there's, there's a little bit of it all over there.
Okay, fair call. Kenneth, much appreciate you taking the time out today and joining us. Thanks so much for speaking to us on this session of Alpha Moguls.
Thank you very much. It's always a pleasure having a chat with you.
Thank you so much, Kenneth. Appreciate your time. And viewers, thanks for tuning in to this leg of Alpha Moguls, and stay safe.